common question asked by many mutual fund investors. Are mutual fund investments tax-free? Let me tell you, the only mutual fund scheme that gives you tax benefits on the principal amount invested is Tax Saver Fund or ELSS. It gives you a tax benefit of up to Rs 1,50,000 which you can claim under the Section 80C of Income Tax Act. But what about other mutual fund schemes? Do you also get such tax benefits? Here's something you need to pay attention to. Though the principal invested in general mutual fund schemes are not exempted from tax, you can still earn tax-efficient returns from your mutual fund investments with some smart decisions. For instance, if you invest in an equity fund or an equity-oriented hybrid fund, any profit or gain that you withdraw from these funds after 1 year from the date of investment is called long-term capital gains, and up to 1 lakh of such profit amount is completely tax-free in the hands of investors. If you wish to withdraw beyond 1 lakh, you will have to pay a long-term capital gains tax of 10% plus applicable cess, but only on the profit amount over and above 1 lakh. However, if you take out profits from these category of funds before a year from the date of investment, you will have to pay a short-term capital gains tax of 15% plus applicable cess on the entire profit amount. When you invest in non-equity funds, for instance, debt funds or gold funds, global funds or debt-oriented hybrid funds, long-term capital gains taxation is applicable after 3 years of holding period. So any gains withdrawn from these category of funds before 3 years is added to your total income and taxed as per the income tax slab. However, after 3 years, you get the benefit of indexation. As per indexation calculation, the acquisition cost is recalculated as against inflation, and using the cost inflation index, which is released by the government every financial year, this will eventually reduce the value of your total profits, thereby reducing your tax liability. Post-indexation, you pay a long-term capital gains tax of 20% plus applicable cess on this reduced capital gains. Now, this could be a major advantage against popular instruments like fixed deposits, which do not enjoy such benefits of indexation. So, in case of fixed deposits, whenever you are earning interest, the interest can attract tax up to 30% if you fall under the highest income tax bracket. Dividends from mutual funds are, however, treated in a different way, that is added to your total income and the tax is calculated as per your income tax slab. Also, the AMC will deduct 10% TDS if the total dividend paid out to you in any given financial year exceeds 5,000. Now that you know all of these taxation rules, invest wisely and ensure that your profits after tax is able to beat inflation and help you achieve your financial goals.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.